All right. Hey, everyone. So we have two awesome VCs from Silicon Valley on stage. By a show of hands, how many people in the audience are entrepreneurs or thinking of starting a company in the future? Awesome. And now, how many of you have raised money before from a VC? OK, a lot fewer hands.
Yeah.
All right. So hopefully we can give some insights. Great. So Greg and Trey, for people who are not super familiar with your track records, could you just tell us a little bit about your current firm that you guys are working on, and then a little bit of sort of maybe the different firm experience you had before that?
Sure, I'll go ahead and start. So I'm Trae Vassallo, and I, about a year and a half ago, started a new early-stage venture firm called Defy.vc. We're $150 million, and our goal is to find entrepreneurs when they're looking to raise $5 to $10 million. Our check size is, on average, $5 million for about 15% of the company. We want to join your board, help you figure out growth, scale, and ultimately go raise a Series B. Before Defy, I spent 11 years at Kleiner Perkins, where I worked on a whole different variety of companies, ranging from enterprise through to consumer hardware. I'd say my big wins during my time at Kleiner included companies like Nest, Dropcam, and O-Power.
Awesome.
Great. And my name is Greg Sands. I founded Costanoa Ventures 6 years ago. There are a lot of commonalities between the firms. Our Fund 3 is a $175 million fund. We're Series A and seed for companies, the whole suite of companies that change the way the world does business. We've got companies like Intact and Datalogics, which we've sold, Demandbase, Elation, Quizlet, which hopefully many of you use as well in the portfolio. Before doing that, I spent 13 years at Sutter Hill Ventures, also based in Palo Alto.
Awesome. So you both work at smaller firms right now. The headlines seem to be often about ever bigger funds, multi-billion-dollar funds, or in the case of SoftBank, a $100 billion fund. What does that mean for you? And is that even the same game? Are they playing the same sport when they have these multi-billion-dollar funds compared to what you're trying to build, Trey?
Yeah. So for me, I mean, the growing size of venture capital firms was actually part of the impetus for why we created what we did. So when I started at Kleiner, gosh, back in 2003, they were investing out of a $400 million fund, and it was a handful of partners around the table doing early stage investing. By the time I left in 2014, there were not one, but two $1 billion funds, a China fund, an India fund, and the firm had really grown in scale. And so what that meant was, in one moment, we're deciding about a $30 million investment into a really exciting growth company with a discounted cash flow analysis. And then on the next minute, we're looking at a company where there's a team, there's a really interesting business model, there's marginal revenue, and we're trying to make a $3 million decision. And what I found is it was really hard to stay focused on those early checks when you've got a lot of money to put to work. So what my experience was that with more capital, the firms naturally tend to go later stage. Now, when you look at the venture ecosystem overall, the observation was money is not evenly distributed. There's a lot of seed capital, a lot of seed firms, and then you have this sort of later stage slide of a lot of these brand name firms that started out doing early stage venture and became later stage funds. And so that created the opportunity for myself and my partner to create a new fund, right-sized and positioned to do those early stage investments.
The way that I'd say it is that the firms that we all know, the 40 firms that think of themselves as top 20 firms, have moved 2 stages later.
Yep.
20 years ago, when I joined the business, they wrote $3 or $4 million checks into what today would be called seed investment. There wasn't a seed category, there wasn't a YC, there wasn't Techstars, there weren't seed-only firms. But now, those are basically, they're mainly Series B and C firms, and there's been this new stage of seed injected before. So for us, and I think the same is true for Trey, this is a way of actually going back to the way venture capital was practiced 15 and 20 years ago. And for us, it really ends up being a craft, and one where we want to bring our expertise and our capabilities and our skills to entrepreneurs and have the wherewithal to stick with them, because we're not always busy chasing the next deal.
So if I'm an entrepreneur and I'm trying to sell my service to a big company, I'll get questions like, how do I know you're going to stick around? How do I know that you can actually deliver what you promised because you're new and you don't have as many references? Shouldn't entrepreneurs ask the same thing of their VC firm? And if you're a newer firm or a smaller firm, how do you answer that question so that an entrepreneur can tell that you are going to stick around and you are going to be a firm that builds maybe a brand like your top 20?
Yeah, I think it's a great question. Fred Wilson wrote a great post this week about broken syndicates, and you don't want your venture capital firm to go out of business, for sure. At the same time, so we're now 6 years into the journey. We're on Fund 3. Every fund has gotten modestly bigger than the prior one. And I think in the end, you can look at me or at Trey, look at prior track record, look at companies that we've been involved with before, and see the pattern. And the most important thing is to do references on your venture investor. Regardless, you can't take somebody's money without doing your own references on them. And part of that reference is, does your business fit with their business model? Venture capital firms have business models. And if their strategy is shoot the moon and pour as much money into it as you can, and tell them to go as fast as they can, that may or may not be what's best for you as a founder.
So what if an entrepreneur has options and they are attracting the interest of a larger VC firm that says, hey, we'll take care of the money in the future too. And we have enough money that you won't have to worry about the months you spend freaking out about a fundraise the next time. What would you guys argue in response to that? And how should these entrepreneurs think about sort of the benefits of going big versus small?
Absolutely. So this is something that we have to pitch to entrepreneurs all the time. Many entrepreneurs are lucky to have the choice to pick investors. And taking money from a firm like ours versus a large firm is very different. And I'd say there are a couple of key things that we often pitch. The first thing is entrepreneurial alignment. When you're at a small firm like ours, one of the things that's interesting is we're entrepreneurs just like you. Our success is dependent on your success. You really matter to us and our portfolio in a way that isn't the same when you're a really small investment in a large fund. We talk about having a right-sized fund for early stage investing, and part of the implication of that is if you're an entrepreneur and you get to Series C and you have an incredible acquisition offer, our fund being smaller is way more aligned with you and the decision around whether you want to sell that or continue to go than maybe a large firm where if you sold at $500 million, you're not going to move the needle for them. So they're going to continue to push you to go further. We see that in spades when you just look at amount of dollars that entrepreneurs want to invest. So again, our average check size is $5 million, and oftentimes entrepreneurs will come to us and say, yeah, but this big brand name firm, they want to invest $10 million or $15 million. And the question back to the entrepreneur is always, well, is that the right thing for you? Is it the right thing for what you want to do? Is it right for the dilution that you want to take? And is it right for the arc of, how much money you need to remove a big amount of risk from your company? And in many cases, it's too much money, and the entrepreneur would take too much dilution. Now, sometimes it actually is the right thing, but that's again, part of the choice that we like to put back on the entrepreneur.
And the only thing that I'd add to that is, it is important, and I think both of us are in this zone, to have enough money to support really important companies. You want somebody who can write a check, go on the board, and who can afford to stay engaged with you during this period of time. So, for example, at a company like Alation, the enterprise data catalog company, we led the seed round, we incubated them for a year, and then came back and led the Series A round. So in the context of these size funds, there actually is enough capacity to lead the next round. There probably isn't enough capacity to lead the next 2 rounds. And that's you might get with a Sequoia $8 billion pool of capital.
Another interesting point to point out, which actually is happening in real time, when you're working with smaller firms, there's also a lot of consortium building that starts to happen. In fact, we are going to be working on a company together, and that's just an example of, sometimes it's better to have multiple investors around the table because you get multiple points of view and you're not beholden to one investor.
Now, if I'm in a place that doesn't have a ton of VCs, you're both based in Silicon Valley. Is it harder or easier to get noticed by, let's say, a really early stage or smaller firm from another geography? Because the one thing about a big firm is they maybe have a ton of analysts who can go around scouting or who can sort of filter up good deals. And with a small firm, it's only a couple of you, right? So I feel like time might be your biggest luxury.
I think that's right. I do think that the big global franchises, the Sequoias and Excels and Kleiners, have spent more time globally. And in our case, 6 years in, we just announced an investment in Toronto in a Kepler, a satellite communications company, in Switzerland, in Auterion, open source drone software company. And we've done 3 things that are based out of Australia. Those have mainly come filtered in by our network and by people that we know, because we don't have a team of analysts storming around the world or the like. And so I do think that, particularly for smaller firms, finding a networked way in is the best way to find them.
Yeah, and you're exactly right. I mean, this is a people-intensive business, and we're investing in companies when it's likely the most time-intensive part of their life, where there is a lot of involvement required by investors to help navigate the path forward. And so, we are limited by partners. So for smaller firms, we do tend, and I know we're more sort of West Coast geographic focused. So yeah, that is one of the differences.
So if let's say I have a couple options, but I don't have every option under the sun, would you say that the brand of, let's say, early stage firm that I work with plays a big impact in what other firms will be interested after? Or how do you kind of balance the importance of brand versus, let's say, the generosity of the terms? Someone who might be a new firm maybe is offering me a cheaper price.
So if I can take this, so I was, for a follow-on investment for one of our companies, I was on the phone till 1 a.m. last night, and then up again at 5 a.m. for the debate with the board, a 5-person board, about exactly this issue. And so this was a Series C, but the universal point of view, it was, because I made everybody, this is what they did while I was sleeping for 4 hours. I made everybody take the key 5 criteria and allocate 100 points to the criteria, so we knew how everyone was weighting, and then rate each one of the firms along those criteria. And on average, the partner, not the firm, was about 35 out of 100 points. The price or terms was 10 to 15%. And then the firm's reputation, its ability specifically to help hire people, and its other value-added services, which some firms have and some firms don't, all aggregated together were a little bit less than half.
Yeah, there's no doubt that firm brand matters, but way more important than that are the relationships that the particular partner who's working with you have. And that is something that you can't just get overnight. You develop personal relationships with the entire investing community, over the course of your time in the business. So I've been in this business since 2003, you even longer. And so that means that when I'm working with a company, I can hand introduce to any number of people that I personally know and have known for a really long time. And so it's those connections that really make the difference. Warm introductions, it's night and day to just a cold email.
Right. And so, for example, the one that we're doing together is one where we led the seed, and I introduced it to Trey, who's ultimately leading the A, and we're thrilled to be working together on it. I think
I feel left out. Well, I feel left out. Can I do
that? Right, exactly. So for those of you who are I do think working with firms that have connections to the major markets, including sometimes to Silicon Valley, is useful. But I will tell you, and this is also part of what we regularly pitch, if you've got product market fit, sales repeatability, great growth rates, and great unit economics, people are going to fund your business, relationships or not.
Yeah.
Okay, so we are... today's a big day in the U.S. with elections. There's a lot of political stuff happening in Germany and England. You can kind of pick your country. And then kind of overlaid on that is people, some people would argue we've been in a long-term bull market for investing. So a lot of political uncertainty, maybe capital markets that might not be the same in a couple years. Should that influence how entrepreneurs think about the money they're raising, and what if they say, oh, this small firm might struggle to raise again or to survive if the market becomes more negative?
Well, so I'd say the philosophy that we have at our firm is to really prudently grow your company. So we're never a fan of sort of the throw money and grow at all costs sort of growth option, because the reality is at any moment the tables could turn and you're going to have to be able to pull back costs and try to do whatever you can to stay alive. So I'd say in general we're kind of always sort of spouting the philosophy of really grow in a frugal, thoughtful way until you absolutely know what's working. And then once you're in a growth mode and it's about pouring cash on the engine, great. But until you're in that mode, be very, very careful. As far as the worry about the venture firms going out of business, I'd say the good and the bad thing is that no venture firms go out of business overnight. And these are 10-year funds. And so the business might slow down. But the important thing is you want an investor, when the times get hard, that knows how to manage and help businesses through the hard times and how to help, again, fundraise in a really tough fundraising environment. And if you're new to the business in the last 10 years, you've not had to do a down round. You've not had to recap your company. You've not had to scrape for money. And if you've been in the business a little longer, you've been through that in 2008, and you've been through that in early 2000s. And so I'd say if you're a new entrepreneur and that is a concern of yours, then look for investors who can help you potentially navigate that path ahead.
I think for me, the stock markets and the economy feel better than the geopolitical environment, and that does feel like a discontinuity. But the reality is most startups are willing to finance themselves for about 18 months at a time. They're not willing to take the dilution for 24 or 30 months of safety. I've just never seen that happen. And the people who write really big checks, usually discipline isn't their dominant characteristic. So if you want to run the business with discipline, it's hard to have someone who just gave you $30 million saying, I didn't give it to you as a safety net, I gave it to you to spend it to grow the business. In my case, I started in 1998, so I survived 01, 02, 03, and it was dead in Silicon Valley for about 48 months. It was brutal. 2008 pales in comparison. So, but look, Trey and I are going to be in the business for a long time. In our case, we've now raised 3 funds. She will have done that 4 years from now. And I think you work with good people, and you can always figure it out.
But so just on that note, last thought is, so if I have less than 18 months of cash in the bank to run my startup, should I be basically trying to fundraise?
I would raise earlier than I might otherwise. If you've got less than 12 months of cash on the balance sheet, yeah, I'd probably raise now.
And I think it's smart to not necessarily always be blatantly fundraising, but always be networking. A warm relationship can always be turned into an investment much easier than a new one.
Well, thank you so much for these insights, both of you. We're out of time.
Thanks, everybody. Thank you.